explores the psychology behind our money decisions. Unlike traditional finance, it doesn't assume we are always rational. Instead, it recognizes our emotions and biases. These factors can significantly impact our financial choices. Understanding behavioral finance is crucial for making sound investment decisions. It helps us identify and mitigate potential pitfalls. Traditional finance theories often fall short. They struggle to explain market anomalies like bubbles and crashes. Behavioral finance offers a more realistic perspective. It acknowledges that investors are not always driven by logic. Our emotions, biases, and cognitive shortcuts play a significant role. By understanding these psychological influences, we can make more informed investment choices. Behavioral finance provides valuable insights for everyone. Whether you're a seasoned investor or just starting, understanding your own biases is crucial. It helps you avoid common mistakes. By recognizing the psychological factors at play, you can develop strategies to mitigate their impact. Ultimately, behavioral finance empowers you to make more rational and profitable financial decisions. Imagine this. You buy a stock based on a friend's recommendation. The price drops. Instead of cutting your losses, you hold on. You hope it will rebound. This is loss aversion in action. We often hold on to losing investments longer than we should. We hate to admit defeat. This is just one example of how our psychology can impact our financial decisions. Behavioral finance is a fascinating field. It explores the psychology behind our money decisions. Unlike traditional finance, it doesn't assume we are always rational. Instead, it recognizes our emotions and biases. These factors can significantly impact our financial choices. Understanding behavioral finance is crucial for making sound investment decisions. It helps us identify and mitigate potential pitfalls. Traditional finance theories often fall short. They struggle to explain market anomalies like bubbles and crashes. Behavioral finance offers a more realistic perspective. It acknowledges that investors are not always driven by logic. Our emotions, biases, and cognitive shortcuts play a significant role. By understanding these psychological influences, we can make more informed investment choices. Behavioral finance provides valuable insights for everyone. Whether you're a seasoned investor or just starting, understanding your own biases is crucial. It helps you avoid common mistakes. By recognizing the psychological factors at play, you can develop strategies to mitigate their impact. Ultimately, behavioral finance empowers you to make more rational and profitable financial decisions. Our minds are full of biases. These are systematic errors in thinking. They can lead to poor financial decisions. One common bias is overconfidence. We overestimate our abilities and knowledge. This can lead to excessive trading and risky investments. Another bias is anchoring. We rely too heavily on initial information. This can lead to irrational decisions. Confirmation bias makes us seek information that confirms our beliefs. We ignore evidence that contradicts them. The herding instinct is powerful. We tend to follow the crowd. This can lead to asset bubbles and market volatility. Be aware of these biases and make independent decisions. Emotions play a significant role in our financial decisions. Fear and greed are two major culprits. Fear can make us overly cautious. We might miss out on potential gains. For instance, fear can prevent us from investing in the stock market. This limits our earning potential. Greed, on the other hand, can lead to excessive risk-taking. We might invest in highly speculative assets hoping for quick riches. This can have disastrous consequences. We might lose a significant portion of our savings. It's crucial to find a balance between fear and greed. Happiness and excitement can also cloud our judgment. When we experience a financial windfall, we might make impulsive decisions. We might overspend or invest recklessly. It's important to remain grounded and make rational choices, even when we're feeling euphoric. Emotions can be powerful motivators. However, they can also lead us astray. It's essential to be aware of our emotional state when making financial decisions. Taking a step back and thinking rationally can prevent costly mistakes. Remember, emotions are fleeting. Our financial well-being is not. Section 4. Market reactions and emotional waves. Markets are not always rational. They are influenced by the collective emotions of investors. When investors are optimistic, the market tends to rise. This is known as a bull market. Conversely, when pessimism prevails, the market declines. This is a bear market. Market bubbles are a prime example of emotional contagion. Investors get caught up in the hype. They drive prices to unsustainable levels. This is often fueled by greed and the fear of missing out. Eventually, the bubble bursts. This leads to a sharp market correction. Market crashes can be equally irrational. Panic selling takes over. Investors dump their holdings, fearing further losses. This drives prices down even further. Such events highlight the powerful influence of emotions on market behavior. Understanding market psychology is crucial for investors. It helps us navigate these emotional waves. By recognizing the signs of a bubble or a crash, we can make more informed decisions. Remember, markets are not always driven by fundamentals. Emotions play a significant role. Section 5. Practical strategies to outsmart your biases. The good news is that we can mitigate the impact of our biases. One effective strategy is diversification. This involves spreading our investments across different asset classes. This reduces our exposure to any single investment. If one investment performs poorly, others can cushion the blow. Another strategy is to invest for the long term. Short-term market fluctuations are often driven by emotional reactions. By focusing on the long term, we can ride out these waves. We can make more rational decisions based on fundamentals rather than short-term market sentiment. Seeking professional advice is crucial. Financial advisors can provide objective guidance. They can help us develop a sound investment plan tailored to our goals and risk tolerance. They can also hold us accountable for our decisions. Developing self-awareness is key. We need to recognize our own biases and emotional triggers. Once we understand our weaknesses, we can take steps to mitigate them. This might involve seeking out different perspectives or taking time to reflect before making decisions. Section 6. Conclusion: Achieving Financial Wisdom. Behavioral finance teaches us that we are not always rational actors. Our emotions, biases, and cognitive shortcuts can significantly impact our financial decisions. However, by understanding these psychological influences, we can make more informed choices. By recognizing our biases, we can develop strategies to mitigate their impact. Diversification, long-term investing, and seeking professional advice are just a few examples. Remember, financial wisdom is not just about numbers, it's also about understanding ourselves. By combining financial knowledge with psychological insights, we can achieve our financial goals. We can avoid costly mistakes and make decisions that align with our best interests. Ultimately, behavioral finance empowers us to become better investors and stewards of our wealth.